Hi, my name's Adam. Welcome to the channel. Thanks for joining us today. Today we're going to talk about a tax planning tool that a lot of you are missing out on. And we do new plans every single day for Canadians right across the country, even abroad. This thing we keep bumping into, and it's something that you have to plan ahead for that most of you aren't. So we're going to go through that in this video. So today's content is around tax planning when you get to retirement. And one of the tools that a lot of you are missing out on is income splitting. So if you're married or if you have a common law partner, this video is for you. Now, if you're single, there's not a lot of income splitting you can do, obviously, so it's not for you, but maybe you know someone that you can pass this video on to. And again, this is good knowledge. You never know. I know people that have got married very late in retirement and this income splitting becomes a part of your plan. So don't tune out right away. This could be for you too. But for those of you that can income split now or look to income split in retirement, part of that process needs to be done pre-retirement. You can't just get to retirement necessarily and start splitting your income. We've done videos, some income splitting videos before, but this, I want to zone in on spousal RRSPs. Now, do they make sense? How do they work? And how can they benefit you and the overall amount of income you generate after tax income and the amount of tax that you pay to CRA? As we know, when you ramp up to retirement, any income prior to age 65, so if you plan to retire before age 65, listen up. You cannot split your RRSP money or your RRIF income until you hit 65. Prior to 65, you can only split your pension. Now, again, if you're in Quebec, it's a little bit different. It does vary, but in general, generally speaking here, if you have a pension in Canada, a defined benefit pension plan, that can be split at any age. So if you're retiring before 65 and have a defined benefit plan, that can be split with your spouse or common law partner. But your RRIF income, if all you've built up is RRIF, and a lot of you, that's your life, right? You don't have that defined benefit pension. You just have built up your RRSPs. You're going to convert that to a RRIF and start drawing on it, but you can't split that until you're 65. So what happens if you were to retire at, say, 60 and you've built up a massive RRSP because you've been the one working and plugging away into your RRSP, and your spouse was maybe at home taking care of the kids or not working or whatever, hasn't built up that same amount of RRSP. So you hit retirement and one of you have 500,000, the other one has zero or close to zero. Again, if you retire before 65, you can't split that income. So one spouse has little to no income, the other one has a lot of income, and it can't be split, so it's very inefficient. Now again, there's a few ways around this. Way one is make sure the spouse has some RSPs. So it's able to draw some, and it doesn't have to be as much. So instead of maybe 500 and zero, maybe it's 400 and 100, but that 100 is in their name. Again, that only works if they had income through the years and it made sense for them to contribute to an RSP. But what happens if that's not the case? That's where spousal RSPs come in. So what you want to do is make sure you equalize the value of your registered accounts, or at least get some money into that registered account for the other spouse or common law partner. So I want to go through a scenario, and I'm going to share my software here in a second, but I want to go through a scenario where it's kind of option one is spouse one has 500,000 and the other person has zero, what the income and tax situation looks like, versus 250 and 250. So the husband in this case put 250 into his RSP and did spousal RSPs for another 250. Again, he gets the tax break on that 250 for the spousal. It's his contribution room, but when she pulls it out, it's going to be taxed in her hands, and it's a way of income splitting. Now remember, before we jump into it, income attribution rule. And what that means is when you put money into a spousal RSP, you have to not touch it for the last year you put it in and 2 more years. So if we put money in 2022 now, we cannot touch it for the rest of 22, 23, and 24. That means that January 2025, we can start to pull money out of that spousal RSP, and income is taxed in the spouse's hand and not in the contributor's hand. So it's very important to know. You can't just plug away and then right away start pulling money out. That income will be attributed back to the contributing spouse, and usually the higher income earner spouse. So make sure that you wait those 2 years and understand the rules around the spousal RSP. So jumping into the software here, you can see this is Dave's asset. Dave has an RSP worth $500,000. And if I go over to Ruth has an RSP worth zero. So again, there's been no tax planning here. Dave's been earning money, been plugging away his RSP. They hit retirement. They plan to retire in a few years at age 60. But again, all the money's in Dave's hands. So when they hit retirement and start drawing income for those first 5 years until Dave hit 65, he cannot income split. And so if we look at a combined view here of total income, you'll see this real dollar income level, $49,750. That is their after-tax income when you look at CPP and OAS in there as well. Again, we've deferred that CPP all the way till age 70, taking the OAS at 65. And they have an income after tax of $49,750. And that goes down all the way through retirement, all the way until they're both 95 years old. If I click on the total tax, so if you have a financial plan put together and you don't have all these details, you need to kind of dig back in and get these details. How much tax are you paying? So if I click on the total tax here, it'll pull up, and in the top right here, you'll see total tax of $266,497. So this is the total amount of tax they're going to pay from now until age 95. Again, whether they live till 95 or not, we want to plan for that, and this does that. So $49,750 with $266 of taxes. Now, if we jump back into a tax planning option where Dave was smart enough to say, look, I'm going to build my RRSP, but I better start building a spousal RRSP because we want to retire before 65, and this is going to be our only source of income, and we need the ability to draw some income for Ruth. So what he's done here is he's put $250,000 into his RRSP. And now if we look at Ruth's RRSP, it also has $250,000. So he's equalized this. Again, not that it has to be perfectly 50-50, but you want to have enough money in Ruth's RRSP or spousal RRSP in this case to make sure that it provides enough income to her and tax in her hands until Dave can start splitting that income at 65. So if the plan is pull $30,000 a year for the 5 years, you need at least $150,000 in the spousal RRSP to make that work. Now, if we go into the same, again, everything else is the same. We haven't changed anything other than 50-50 between their two accounts, utilize that spousal RRSP. And you can see the income is jumped up from $49,750 to $51,117. This is after tax in their pocket money. So a nice little bump, right? About $1,300, $1,400 a year, $100 a month after tax. That's a good bump in income, especially at this level. If we look at their total tax bill, it's gone from $266,000. We're down now to $234,000. So again, we've been able to kind of split that tax early on, which reduces the overall tax bill, which again generates more money and gives more money after tax to the client, which is always what we're looking to do. When we build a financial plan, how do we maximize the after-tax income in your pocket, reduce the tax bill to CRA, and at the same time, create a better estate, whether that's at 75, 85, 95. How is that estate looking, and is it getting bigger? Or at least staying the same while paying less to the government and putting more in your pocket. Those are kind of the 3 check boxes we're looking to do. Again, if you're planning to retire before age 65, make sure that you look at your accounts now, plan ahead. If your spouse or the lower income earner isn't building up an RRSP, you should probably start building up a spousal RRSP for them, if that's an option for you. Again, if you have a pension plan, a defined benefit pension plan, that can be split. That's probably going to solve a lot of your issues. But again, get a plan in place so you know that is there a discrepancy in tax rates. What we look at is your average tax rate in retirement. And we want each client to have a pretty level tax within about 3 or 4% average tax rate right through retirement. But we also want husband and wife or partners to have similar tax rates as well. So if one partner is say 10%, we want the other person to be at 10. We don't want 15 and 2. We want 10 and 10. Or 11 and 12 or something in that range. We want them very close together. So that helps create a lower tax bill as a household and puts more money into your pocket after tax to enjoy retirement. So thanks so much for joining us in this video. Hopefully it helped. Again, we want to kind of jump into some of these more planning details, sharing our software with you going forward. I think this adds a lot of value. We get positive feedback. Again, if you have questions on this or have any comments on how you've utilized the spousal RRSP or income splitting, leave a comment below. If you have ideas for videos going forward, we're always open to new ideas. We have a lot of them, but we're always open to more. Again, leave that comment below. And again, if you enjoy these videos, please hit the thumbs up. It really does help get these videos out to more people, and more people need to hear this content. So thank you so much for your time, and we'll see you in the next video.